Welcome to Subramani. I'm going to talk about what I do with my money and why, to me, performance benchmarks do not matter. My only aim right when I started investing has been to get a higher dividend yield, and this I'm saying right in the 1980s. And in 91-92, Chidambaram made it very convenient by abolishing tax on dividends. Make no mistake, I know that when he abolished tax on dividends, he was not doing us a favor because we were paying tax at the highest rates in the form of DDT. Because I would have been as a student obviously on a lesser tax bracket, but 91-92 I had started earning, so I found it convenient that I didn't have to tabulate the dividends and worry about the TDS, etc. Now again we are back to all the old problems. But anyway, that's not the purpose of this talk. I used to look at dividends and say, okay, since I've got dividends, I have to invest it back. To me, honestly, it didn't matter whether I was outperforming the index or underperforming the index. The benchmarks didn't matter. In fact, I think benchmarks are a big pain because once you see it, once you read it, however calm a person you are, there is always a tendency to worry saying, oh my god, should I sell Colgate and buy HUL, or should I sell HUL and buy Colgate? Because there have been periods in time when Colgate would have underperformed, and there would be periods in time when HDFC would have underperformed. There would be times when HDFC Bank has dramatically underperformed Chola investments in finance. To me, honestly, nothing mattered. What mattered was, are these companies which are paying me increasing dividends on a year-on-year basis? That's the only thing which really bothered me, because the aim was at some stage to have enough dividend more than the current household expenses. So if your household expenses are 50,000 a month and your dividends are about 50,000 rupees a month or about 6 lakhs a year, it means you can now be financially free, assuming that you have no reason to touch the corpus till the end of your life. Or you start touching the corpus somewhere in your 80s and you die at 90. That's still okay because you've created a huge corpus. So for me, how would it matter whether Coromandel fertilizer was doing better than Zuari or Zuari was doing better than Coromandel? To me, that didn't matter. What mattered was how much dividends were they paying. Were they paying good dividends? So something like Apollo was available below par. HDFC, I've seen it at par, which means I've actually bought below par. It used to be 100 rupee share available at 97 rupees. Equivalent of getting a 10 rupee share at 9 rupees 70 paise, right? So to me it mattered that there I was getting good dividend yield. HDFC Limited used to be a good dividend yield company. I never bothered whether it would grow, right? The problem is if you read the press, then they will tell you that, oh, FMCG is underperforming, metals and gold is outperforming now. You may know that is happening, but the question to turn around and ask is, what do you need? You need dividends, right? Are you getting good dividends from these good companies, or are they slipping in the market? Are they paying less dividends? So to me, one important criteria was rising EPS over a period of time. Now, of course, it's become very easy. I can say, okay, last 13 quarters or 15 quarters or 14 quarters or something like that. However, when I started sometime in the 1980s, it was not even half-yearly results. Forget quarterly results. Then half-yearly came and then quarterly came. Now, there is too much noise around the quarterly results of companies saying, oh, company has underperformed, company has done this. Honestly, it will disturb you. Even my monitoring of mutual funds was always simple. I used to tell people that I used to open the file and see the fund manager's name. As long as it had Prashant Jain, Naren, Anand Radhakrishnan and the works, I would not really bother too much, because you know that these people, they may make mistakes, but they're perfectly capable of coming back and correcting it. So if they are going to do the correction, I never thought I needed to do the correction, and over long periods of time, I'm sure there is underperformance in some parts of those portfolios. But it has not bothered me, because all I want is one day I will use those funds for generating cash income for me. Right now I am sitting on 20 years capital gains, right? So how does it matter to me what they are doing? And even if the current returns fall, I know that there are guys who are capable of coming back and performing. Now, typically, I have Carborundum Universal, Cholamandalam Vent, all belonging to one group. I had a lot of Tata Power, and I recently bought Tata Power. Tata Power at the price at which I bought is again suddenly giving 5% dividend yield. When I bought, it was giving 7% dividend yield. That was, of course, eons back. So, if you are an investor investing your family wealth, the only thing which you are looking for is absolute gain in terms of after reducing inflation and taxes. You're perfectly alright with your portfolio without worrying about benchmarks, provided you have the equanimity to realize that you're staying away from the noise. And you're not really bothered about what you discuss tomorrow evening at a party saying, oh, I bought Z at this price, but उसमें dividend yield नहीं बैठता है, or things like that. Or are you saying, I really don't care what others think, what others do? As far as I am concerned, I will have a dividend portfolio, largely a dividend portfolio, and small portion of some growth portfolio also of companies which don't pay dividend. Because one day when the prices go up and the company declares a dividend, the prices would go further up, saying, oh, there is certainty in what they are talking. They are not just talking, they have the cash flows to support what they are saying, right? So all that to me is important. What is the company doing? Is the company giving increasing dividends? That is a great sign. Or every quarter is the EPS going up? And then you look at the company and say, oh, this company, this is Lakshmi Machine Works. Now there is a problem because, but hey, please remember, Lakshmi Machine Works is the one who's got a defense project, right? So going forward, the dividends will go up. Right now, the dividends may be a little subdued. So I look for both types of shares. Growth shares which will not pay a dividend for some time, but then I cut it off if it doesn't pay dividend after 5 years of holding. And one regular dividend yield stock which gives 5%, 6% kind of yield. So sometime in the month of March and perhaps in the beginning of April, I filled my portfolio with a lot of PSU shares which are giving very good dividend yields. My logic is very simple. If the government does not have enough money, it will come to the private sector, it will come to the public sector and want to sell shares. That would be a great time for these shares to either increase the free float by doing an IPO or by doing a follow-on public offer or by selling stake to others and the government really dramatically reducing its own stake. That could see an appreciation, and anyway you are sure that the government will force them to pay big dividends even if they can't afford to, and that again you are a beneficiary, right? So looking for a portfolio which will be dividend paying is very good. I am talking of a direct equity portfolio. I am not talking of a mutual fund. So mutual fund taxation is very different from regular taxation of dividends, right? So largely looking for good dividend yields so that I can invest my money and get a decent income post retirement. Thank you.